Hey guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investing stocks in Asia as well as in personal finance. Well, today we want to talk about SPAC, Special Purpose Acquisition Companies. It has been quite a hype in the past few months, especially in the US. So what's so special about SPAC? In theory, there's only upside potential but no downside potential. It could go up to 600% within 1 year, but on the other hand, it has a minimum value that it would go down to, which we will go into details later. But is it too good to be true? I'm not saying that it's a scam, but certainly there's a frenzy. Last year in 2020, there were $100 billion being raised through IPOs using SPAC. And this year alone, just the first 2 months, already $3 billion were being raised using IPO with SPACs. And certainly there's a degree of speculations around it. Well, it doesn't mean that we are not going to make money out of it, right? So one step back, what exactly is SPAC? SPAC is nothing new. It has been there for decades in different shapes and forms. SPACs are basically shell companies or the so-called blank check companies that has no business but only capital from the investors. You would say, okay, what's the purpose of it? Because SPACs is a very simple company, so it's easier for them to be listed on the stock exchange through IPOs. If you don't know what is IPO, check out my video here. After they listed, the sole purpose of the SPACs would be to look for an acquisition target. So they either merge or buy companies that have a business. So you would say, what's the point of doing that? If a company wants to list on the stock exchange through an IPO, there are complicated procedures to do it. It could take months or sometimes even years. Needless to say that it's very expensive. That's why if a business merged with a SPAC, it will be much easier and faster for them to go on listed on the stock exchange. For every SPAC, they have a deadline. Usually they're 18 months or 24 months. So if after the deadline they are not able to secure a merger or acquisition with a proper business, then they will shut down themselves and give the money back to the investors. This leads to the point about this so-called safety net. This is the interesting point. Usually they are listed at $10 at the IPO, and in theory, if the company is being dissolved, they will also need to return around $10 to the investors, which I'm going to talk more into details later. So what is it in for us as an investor then? Well, it is expected that the value of the SPAC would go up a lot if the founders are able to find some really good deals and merge the company with them. And of course, there's also another factor, which is the upside potential versus downside potential. In theory, there's only upside potential. It is particularly attractive given that the worst case scenario, if they cannot find a merger and acquisition target, the $10, which is the initial share price in the IPO, would be given back to the investors. So in theory, you're not going to lose any money. Indeed, the cost of running SPAC might be deducted from $10, depending on the contract, and the costs are always clearly predefined in the IPO prospectus, and are usually designed to be minimal. Also, there's one thing that most people missed out is that if you want to hold the stock of the SPAC after the merger, the equity you hold would be greatly diluted. What does it mean? So imagine there are two retail investors, Danny and Eric. Each of them contribute $10 to the capital. So there's $20 in the capital, right? Richard, who is the founder, he is supposed to find an acquisition target. And if he managed to find it, he will be awarded a share as well that is also worth $10, even though he almost doesn't need to pay anything for it. Then you imagine $20 of capital now being shared among Danny, Eric, and Richard. 20 divided by 3 is 6.67. That means the cash value of the company would be $6.67 instead of $10. I'm not saying that the value of the company would go down though, because there will be also value from the acquired business. So the so-called $10 safety net will no longer be $10 after the merger because of the dilution of the equity. Hold on, so you mentioned about the founders or the so-called sponsors, right? What does it mean for them? Of course, they're no charity. They're going to earn a huge amount of money if they're able to find an acquisition target and acquire them. They usually allocate around 20% of the share in their company with very little capital involved. It could be as low as $25,000 for 20% of the share. Imagine if the company really get a good deal and merge with a good business, the whole company could worth several $billion. Imagine how big the profit they can get. At least the good thing is that the founders are incentivized to increase the share price, which is in line with our interest. Okay, that sounds like a good deal. So what about the risks? 247 SPACs were being listed last year in 2020. So you can imagine that there's so many SPACs competing for a limited number of good deals. So there's a good chance that the SPAC cannot find a deal. Secondly, even if they are able to find a deal, the valuation of that business could be highly inflated because there's so many competition and the business can choose among many SPACs. Worse still, the sponsor could buy a very crap company. Why? Unlike us, the investor, which each of us contribute $10 per share. For the sponsors, they basically get it for free. So whatever company it is, as long as it's going up even less than $10, they can still earn a lot of money. Well, if you bought this share at a price much higher than the IPO price of $10, and one of the scenarios mentioned happened, there's a good chance that the share price might fall below your purchase price. Also, you need to note that the trading volume of SPACs are usually much lower than the normal shares. So there's a chance that you cannot sell your share, or even if you can sell your share, the price could fluctuate a lot. Last but not least, also the opportunity cost you have, because you might be stuck with the SPAC for 2 years, which otherwise your money can be invested elsewhere. The main story indeed is that the stock price of SPAC can go up a lot, sometimes even up to 600% within 1 year. And the downward risk is pretty limited, especially if you bought the stock at $10 at the IPO price. Even though they could not get a deal at the end of the 2 years, you are still able to get most of the $10 back. From a skeptical point of view, this is clearly a speculation. We have literally no say about what kind of assets they're going to buy, what kind of business the SPAC is going to do. Well, true, we also have no control over what conventional listed companies are doing. But at least when we bought them, we know that what kind of business they have and whether they're making money or not. It's the industry and the geographical location of the potential deal. For example, like Bridgetown, they focus on technology, media, financial services in Southeast Asia. That's it. That's all you know. You rely heavily on the reputation and the trust you have with the founders. So what else you can call it apart from speculation? And one most important point is that you should sell it once a deal has been announced before the merger actually happens. As I mentioned, your equity would be heavily diluted if a deal is actually done. In fact, some study finds that the stock price of a SPAC after merger could go down at least 1/3. This is certainly not the type of stock that you're going to invest, forget about it, and hold forever. I'm going to talk about some more SPACs later that I like in particular in the next videos. But for now, what do you think about them? Do you like them? Are you going to invest in SPACs? Let me know in the comments below. If you like the video, remember to like it, share it, or subscribe. That would be great motivation for me to make more videos and better videos about personal finance and Asian stocks.